Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Welcome to FRA's Roundtable Insight. Today we have a special treat for you. We have Jayant Bhandari. He is an institutional advisor. He advises institutional investors about his research. He's worked 6 years with U.S. global investors and 1 year with Casey Research. He has written on political, economic, and cultural issues for the Liberty magazine, the Mises Institute, Casey Research, Acting Man, International Man, Mining Journal, Zero Hedge, Lou Rockwell, The Dollar Vigilante, Fraser Institute, Malden Economics, Northern Miner, and Mining Markets. He is a contributing editor of the Liberty magazine. And also today we have Barry Habib. He is the CEO of MBS Highway, which forecasts the direction of interest rates and residential real estate prices. A longtime guest on both CNBC and Fox, Barry has also been a professional speaker for the past 25 years. And here is something interesting. Barry was the lead producer and managing partner in Rock of Ages, which was the 27th longest running show in Broadway history. Welcome, gentlemen.
Hi there.
Hi, thanks for having me, Richard.
Great. And with that, today we would focus on how financial repression is going together with fiscal policy stimulus. And this is quite interesting now, given the recent presidential election, having President-elect Donald Trump win that, and his mandate on using a fiscal stimulus approach for infrastructure spending. So there is a quote that I wanted to relate from Russell Napier, a strategist with ERIC, and he sums it up quite succinctly. What he says is that government will bring measures to stop you and I from gearing up, which are the elements of financial repression. They have to try and force you and I to buy government debt, even though it is virtually guaranteed loss-making proposition. Then they have to bring in controls that would stop us behaving naturally as a response to negative real interest rates. Now, those historically have been some horrific things. A lot of people think central bankers will keep going forever. But if we ever go to inflation, they clearly have to stop expanding their balance sheet. Somebody has to buy the government debt. So let's say the fiscal policy comes. It succeeds, we get growth, we get inflation. Central bank balance sheets cannot expand in the growth and inflation. So who's going to buy the government debt? The answer is you are. Particularly if you work for a regulated financial institution. It's much better if you're an individual, but regulated financial institutions are the people who will be expected to do that, and that is financial repression. So I'd like to begin with some observations by Jayant in terms of what he sees happening in India. He's recently been to India, and there's some interesting developments there with regards to financial repression and what's happening with regards to the war on cash and gold. Jayant?
So, Richard, something very interesting happened in India on the 8th November night. What Prime Minister Narendra Modi did was that he banned rupee 500 and rupee 1000 banknotes, which are equivalent to $7.50 and $15 US dollars respectively. He completely banned these currency notes, which represent about 88% of the total monetary value in circulation. These two banknotes are the most commonly used banknotes by poor and rich people alike. He banned it despite the fact that 97% of the consumer economy of the country is based on cash, which means that in this extremely poor and wretched country with per capita GDP of $1,600, where most of the country does not even have electricity, Wi-Fi, telephony. They have pretty much banned cash and brought the economy to a standstill. They coincided this with the US elections so that the world would not pay much attention to what was going to happen in India. But in my view, this is creating a massive crisis situation in the country for only one purpose, and that is to maximize tax collection, irrespective of what harm it does to the Indian society.
And so what are the drivers of this? Why is the government doing this? And how and why is it affecting, for example, the price of gold?
Well, the gold price currently in India, if you can find gold in the market, is anything between $2,000 to $3,000 per ounce. Now, this might sound unbelievable when the gold price is falling internationally. The reality is that people are now in a desperate situation. The savers are pouring their money into gold. So that is the kind of gold consumption that you can see in India right now, because people are being forced to use the cash they have.
And is the price of gold going up in rupees or US dollars or both?
Oh, both. It's what I'm saying is I'm converting the rupee price into US dollars. Now, rupee price should be about 10% higher than the US dollar price, but right now it's almost 100% higher in India than it is in the United States. And the reason is that this sudden repression of cash economy has forced people to divert the cash holdings they have had into physical gold.
And do you see the repression of cash as a trend going to lower denominations as well?
Well, no, but remember, bad money drives out good money. So what is happening is that the moment they banned 500 and 1,000 rupee note, they are exactly the notes that are currently in circulation. All the lower denomination banknotes are rapidly going out of circulation because people with any kind of financial strength, the moment they get hold of any of these lower amount of banknotes, they just shove them under their carpet, which means that the 12% of the monetary value, which is still legal, is rapidly going out of circulation. The country, India's economy, is rapidly going into paralysis right now.
And if this continues, would the government react by going towards maybe restrictions on the imports of gold, or banning gold ownership outright, or extending the repression of the notes into lower denominations?
Absolutely, Richard. Once you start the process of social engineering, you have to keep taking corrective actions, because the normal guy on the street will try to protect himself. So the moment they started banning the currency notes, people will want to go into gold, and government will indeed very soon come up with some kind of regulations to restrict people from buying gold. And then they will impose some other kind of restrictions. This is just the starting of a police state in India, and I don't think this will stop until it has become a complete, full-fledged police state.
And could this happen elsewhere? So if we look at outside of India, could this type of trend happen? For instance, recently in Australia, there was also some movements in the war on cash and restricting the use of physical cash there. So could this spread elsewhere?
Well, Richard, Indians do not have moral instincts. They are very irrational people. So these people did not resist the government then when the government imposed a ban on currency notes, which is really confiscation of private property. Now, as we have seen, the Western societies are increasingly becoming irrational. The moral instincts is being taken away from the Western society using socialist and welfare and warfare economies. Eventually, people in the Western countries will become capable of not resisting the government when they start seizing private properties. And I think eventually a date must come when the governments have no more capabilities left to print more money. They will go and confiscate people's money. And really, the fiat currency system is a paper-based system whose value is dependent on regulatory edicts. It does not have any inherent value, and the government at any point of time can reduce that value to zero just through regulations.
Yes, indeed, and we see there's been a trend, obviously, in recent years in using that fiat currency to monetize debt, to perform quantitative easing, money printing, in order to, for example, keep interest rates low. Barry, what do you think on the interest rate trend since the election of Donald Trump as president-elect of the United States? We're seeing the long end of the yield curve going higher in terms of interest rates, coupled with rising inflation. Do you see that as the beginning of a new trend?
Well, first of all, thanks for having me, Rich. It's really great to speak with you. And by the way, I was enjoying the comments and learning a lot about what's going on in India. It's pretty amazing. Right here in the U.S., as you may know, Rich, we were way ahead of this and forecasted this happening. Certainly when we were together, we talked about rates rising, and we had a target of 2.85% on the 10-year, which, as you know, that was recently hit. And we're currently at a really important juncture here. This is a pivot point. If 2.85 on the, 2.385 can hold on the 10-year Treasury, which is an important Fibonacci ceiling, then we could be, because we're so oversold on price and it's so overdone on yield, we could see from this point a little bit of retracing and a little bit of relief where we'll see yields drop. And we're not going to see them drop to where they were in September, but we should see some benefit. Same thing on mortgage-backed securities. We should see mortgage-backed securities from these levels come back a little bit. So there could be some relief there, not a whole heck of a lot compared to where they were. And you asked, why were rates rising? Do we see the trend continue longer term? So rates really started to rise in mid-September, and that was because of global factors. When the central banks in Europe and in Asia said, so to speak, oops, going to negative rates don't have the desired effect, and let's bring rates back towards zero, it kind of diminished the appetite for bond buying. And that was the very beginning. That was the first signal. So in the past, rational people would think that zero is a floor, but once negative interest rates came into play, then theoretically nobody wants to have a negative yield, but there was so much money to be made on capital appreciation that people said, okay, the heck with the yield, that's nothing compared to the capital appreciation. And theoretically, with negative interest rates, there was no longer a floor, and you could theoretically make an infinite amount of profit so long as interest rates could keep going down. So that spurred a lot of animal spirits in buying. But since we've seen zero become more of a rational floor across the globe, since it killed the banking system, hurt the stock market, didn't bring the desired effect of inflation, and did not spur economic growth. So what we're now seeing is we are seeing that tempered appetite, and that started it. Then after Brexit, the fact that the pound kind of fell out of bed has made the exports very nice for the UK, but it's caused quite a bit of inflation fears, as you earlier mentioned, because they are dependent quite a bit on imports. And the gilts have doubled in yield as a result of this, just since the inflation figures have started to come out. So because of that, in sympathy, we've seen yields rise in Eurozone on the bond. We've seen them rise in Asia. And of course, we've seen that same thing happen here in the US. And then after the election of Donald Trump, people kind of woke up and said, hey, wait a minute, maybe this is a good thing to have less regulation, take the neck off the throat of business, and started to suddenly wake up and smell the optimism. So stocks started to make quite the move, as you all know. But we also have to remember that stocks and bonds tend to more often than not be on opposite ends of a seesaw. And since they both tend to compete for the same investment dollar, as stocks rally, some of that money comes out of the bond market to catch the faster horse, so to speak, in stocks at the time. So we have seen a transition out of bonds and into stocks, and that selling has hurt the bond market. But now we do have, as I said, an opportunity to take a breather, kind of retrace a little bit, so you could see an opportunity to make some profits here in bonds, and perhaps stocks overdue cool off a little bit. Now, on December 14th, yes, we're going to get a Fed rate hike, and historically speaking, every time that happens, bonds tend to improve and stocks tend to take it on the chin a little bit. I think that same scenario will take place once again because it's happened with about a 100% correlation. But then longer term, you're right, Rich. I mean, I think everything is in place for yields to rise, not crazy, but at least a little bit. And then the impact on housing is so strong and so good. And you and I have talked about this in the past. And although some people have had questions about this for the past 5 years, we've remained bullish. And I think that housing will weather the storm and continue to be a good opportunity.
Back on the bond market, so the recent sell-off by various central banks, including Saudi Arabia and China of U.S. Treasury bonds, do you see that as a continuing trend, putting a damper on U.S. government bonds?
Well, what's interesting is the complete reversal from everywhere, from Japan, from China, from everywhere in foreign central bank buying of U.S. bonds. And it's something that, we had discussed and pointed out. And I think about a month ago, our good mutual friend, Peter Bookvar, in his daily piece, he actually put some of the numbers just for comparative nature over the past several years, how they've gone from such enormous buyers to now rather significant sellers. It's difficult to say because one of the ways that countries whose currency, like China, is pegged to the U.S. is to repatriate some of the dollars they receive in exports by buying our treasuries. So you wonder how long that will last, and maybe that will come back. But it is certainly having an effect, as you mentioned. It is one of the negatives because that lack of buying has to be picked up somewhere. And it's currently not going to be picked up domestically if you've got a stock market that's on fire that you're trying to chase.
So who will be buyers of U.S. government debt? As Russell Napier points out, will it be you and I? Will there be repression in the form of perhaps a change in the 401k rules for forcing investors to put money into government debt? Or will there be some measures like that, or will there be further quantitative easing by the Federal Reserve in terms of monetizing the government debt? Any ideas on that?
Well, it's always been you and I, and the best cure for high rates is high rates, right? Because the market will take care of itself. And here's the other thing to consider. Donald Trump has some very good ideas with respect to the fact that our country does need quite a bit of infrastructure build, but we just don't have the money to do it unless we borrow it. And how do we borrow it? By issuing more treasuries. And it would be wise to consider at these rates that would be paid out to use instruments of a longer duration, 30 years, 10 years, maybe creating a 100-year note. Who the heck knows, right? So when that happens, that additional supply that comes to the market will need to be sopped up. And the only way that you're going to get people to sop that up is to have higher yield. So the market will take care of it. So will there be a buyer? There'll always be a buyer. It's just a function of price. There is going to be some yield that people will come in and buy with both hands. So is that yield currently at 2.38? I don't know. Is it going to be at 3%, at 3.5%? That's where things will level out. And that's one of the reasons why we had said longer term, we see yields moving higher. Not crazy, but we do see yields moving higher for a few reasons: to sop up some of the supply, to make up for the foreign demand that has not been there and may not come back. And certainly, if there is infrastructure to be built and bonds to be issued, higher yields must come into play in order to incent people to sop up the excess.
And Jayant, what are your thoughts on this in terms of the U.S. government bond market? Do you see similar trends happening?
Well, what is happening, Richard, is that while the Western countries are suffering, in my view, what I have seen, except for China, in the emerging markets, the situation is much, much worse. These people did not really learn to create their own technology. And these countries have plucked the low-hanging fruit that came into existence because of internet. They could rapidly bring in technology from the West to the emerging markets. And now the low-hanging fruit have been plucked. And in my view, a lot of these emerging markets are stagnating and pretty much becoming negative yielding economies again. The result is that despite the fact that US dollars and euro and British pounds have their own problems, these countries people of these countries still see US dollar as a very good way to preserve their wealth, because they tend to trust the US government more than they can trust their own economies or their own governments.
And so would that imply international capital flows into the U.S., into U.S. financial markets?
Well, that is in a way already happening. American institutions are pulling their money out of the country, which is pretty much the same thing as those people sending their money to the US. Yes, indeed, I think these countries have historically subsidized American government's printing press, and I think they will continue to do so in the near future because these economies are not doing well. And the only exception I make is that of China and perhaps South Korea and Japan, Singapore and Hong Kong, but all of Africa, Middle East, South Asia, most of South America are suffering because they did not really learn the good things from the Western civilization. They picked up all the consumerist ideas, they picked up all the entertainment aspects of the Western societies, but they did not really pick up the creative thinking, reasoning capabilities, and institutional building from the Western society.
A lot of the international capital flows into the U.S. recently have gone into purchasing real estate assets, something that also has been happening in Canada. Barry, do you see that continuing in terms of foreign buying of real estate assets, for example, in Miami and New York?
You know, interesting, because I would have answered that question yes, but then you said Miami and New York, and I'm a little bit more skeptical there, just because those markets, along with the San Francisco area, just a bit overdone, perhaps. Now, I don't think that those markets are in for a crash. I just don't see them as having the most upside. I think they're a little bit pricey, and they more than likely will lag some of the other areas that have some catching up to do. So, yeah, if there's going to be some foreign investment in real estate, certainly a very good way to do it and a very good way to leverage it. The thing of it is that they may cherry pick some of the markets that have a little more upside.
And given a lot of interest in U.S. real estate, in Canadian real estate, especially by foreign buyers, and also from the fact that many North Americans shifted some assets from the financial markets into the real estate markets after the financial crisis, and the fact that governments in the U.S. and Canada are in dire straits in terms of debt and deficits. Barry, do you think that there could be a potential for governments in North America to institute wealth taxes on real estate? So by that I mean, if we look at
it's already done. Yeah, it's already done in some areas where New Jersey, New York, where you sell, you're going to pay mansion tax and things like that. But you bring up some good points. So it's really a couple of things that we see happening here. First off, take a step back on the investment in real estate. If you're a foreigner, you may want to really invest in real estate or as an individual in treasuries, not just because of the fact that it's potentially a better investment or a good investment on its own, but as a foreigner, you get the benefit of the currency move. This is something I wrote in and talked about on Fox, and also wrote on in Walden's piece and spoke about at his conference that, at the time the dollar-euro relationship was different. I said, but guys, here's the thing. If you look at the play between the dollar and the euro, and if you were to say, okay, if you invest in U.S. treasuries, forget the fact you're getting at the time a sub 2% yield, you make the money on the currency. When you figure in the currency gain, you get a 20% return on your money. Forget the 2%. The real play is the currency. So if you think, like I do, that the dollar will continue to show strength and go to parity or sub-parity against the euro and continue to show strength against some other currencies, which I think it will, and I think that the Jayant mentioned that people do trust the U.S. dollar as opposed to some other currencies, and perhaps he might agree that the U.S. dollar maybe has a little bit further to go. You're going to continue to get that foreign investment. In regards to a wealth tax, I don't know if you'll see as much play for a wealth tax under the administration that we have now, but I think what really has a shot is a VAT tax here in the U.S. So a consumption tax, some people think it's perhaps a bit regressive. However, you're only going to be spending it on things that it's the bulk of it's going to be on items that are more higher ticket that upper incomers can afford. And I think that could really generate some growth. So I think that has a better shot with this administration that we're going to be seeing as opposed to a wealth tax.
And Jayant, in India, I recall there was some development in wealth taxation for non-financial assets or financial assets outside of the banking system. Is that the case in India, and how does that appear?
Well, Richard, I recently stayed in a hotel in India, and my one-day accommodation at a hotel listed about 7 or 8 different taxes that I had to pay on that one day of a stay. There are regularly new taxes being imposed in that country, and they are going to converge all these taxes into one, but then there is already a talk about adding more and more taxes on top of all these things. So the government is extremely rapacious, and they will steal as much of money as they can from the pockets of people. And I think imposition of wealth tax is going to increase going forward, because the country is becoming a very fascist state under the current government. They want to take away as much of the savers' wealth as they can, particularly because the middle class, the salaried middle class, is very indoctrinated, and they look at life in very simplistic terms. And as long as they are themselves not suffering much, they are very happy to let that happen in the society. And I think that is the way forward for that country.
Interesting. And so, given all these developments, gentlemen, what makes sense for investors in terms of investing in the financial markets, in the real estate markets? What would you recommend in a generic sense, Barry?
Well, I think that if you want to do a trade, I think right now trading, I'd go long bonds, and I'd be cautious stocks, maybe pick up some VIX. I think that's a short-term trade. Longer term, I'd be short the bond market. I think you get a little bit of recovery, and then a Fed rate hike helps them. But then after the effects of the Fed rate hike wear off on bonds, I'd be short the bonds just as we have been of late. You should see some very, very nice gains. I happen to really like residential real estate in many parts of the country, not everywhere, but in many parts of the country, I think residential real estate is a very good investment, and especially because you can leverage it. I mean, we're looking at about 6% gains this year. I think 5 to 6% for the next year is a reasonable assumption. Some areas will be hotter than that. based upon that, you can leverage that 5 times, 10 times. You can get a rather significant rate of return on your investment. So I see those as excellent opportunities.
Interesting. And Jayant?
Well, I completely agree with what Barry says. I think real estate is very good in my opinion. Partly, and my point of view is that a lot of these people in China and India and Africa who are rich and who want to protect their wealth still trust the American government more than they trust their own government. And they will continue to buy more and more properties in North America and in Europe. But also, I like investing in gold because I think we will continue to exist in a negative yielding environment. And in a negative yielding environment, gold and silver is a good place to keep your money because it at least gives you zero yield. I also like Far East Asia, China, Korea, and Japan. I think they are very good countries to invest in. There is very good growth is still happening in China. I also like Hong Kong and Singapore. Just because these are very passionate people, they have energy, and the society is geared towards making money, towards growing their economies.
Excellent. And how can our listeners learn more about your work, Barry?
Very easy. We're at MBS, like mortgage-backed security, mbshighway.com, or my email is barry@barryhabib.com, and can contact us anytime.
And Jayant, how can our listeners learn more about your writings and your work?
Well, everything is on my website, which is jayantbhandari.com.
Great. Excellent. Thank you very much, gentlemen. And we'll have you back for another session of the Roundtable Insight. Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.